So this next talk is about public goods funding, and it's also about governance. I'm going to give a quick overview of the proposal. So I've spoken to many people in this room about it, but not everybody and not a wider audience. So the main thing really is to canvass more feedback after giving a brief introduction. Okay, so some context. The Filecoin ecosystem has successfully prototyped two major classes of public goods funding mechanisms, retro PGF and pro PGF. Yet, I don't think we've reached a steady state in terms of where things are going in mechanism terms. There's a lot more to do in terms of being more sustainable, more robust, more decentralized, more on-chain. So the next step we'd like to propose is to transition these programs to protocol-native funding sources. And doing that requires also having protocol-native governance. And so really this is the purpose. Really, this is what this talk is about. It's about veFIL, and this is the mechanism by which we propose to align stakeholders with governance and outcomes in the network. So, a little bit more context again. I'm going to focus on retro PGF because this is something of interest to me in particular. What does public goods mean for Filecoin? Well, it means all of the stuff that you see here. It means a huge range, hundreds of applications being submitted, many projects being funded. It means having a credible mechanism to fund public goods in the network. Credible mechanisms, plural. It means having multiple donors, and it means supporting all of these different things from research, tooling, infra depths, education, and governance. And a little quick spotlight on impact. So this was the last round of retro PGF 2. You can see here I've highlighted a few projects, their logos on the right-hand side. So you see Curio, Chain Love, PhilB, Drand, Lighthouse, actually even Phil Dev Summit is a recipient. So these are some of the great things that public goods and Filecoin is funding. And a spotlight on the funding itself. So I'm just going to talk about retro PGF, which is only one part of public goods funding in the network. But in retro PGF alone, there's been more than a million FIL donated to the program, which is a pretty huge amount. And this has come in large part from Protocol Labs, but also a very substantial amount from Filecoin Foundation and a bunch of other companies that operate in the ecosystem. So while the funding from all of these range of donors is very good, I think we want to get to a place where we're more robust and not relying on the goodwill of individual donors. So this is where it comes into making things really more protocol native, establishing on-chain governance and a way to govern the use of public goods funding coming from the mining reserve. So that's the first aim of this FIP, which I'm describing. The second aim is to align stakeholder incentives in terms of tying governance power to yield and long-term economic conviction, which is precisely what veFIL intends to do. So this is how we intend to do it. This is a diagram which encapsulates the concept of veFIL. So in essence, one locks FIL and receives veFIL in return for some amount of FIL committed for some duration. And this will enable participants to essentially be in charge of selected governance decision-making around the use of the mining reserve to fund public goods in the network. So how does it work? Vote-Escrowed is essentially based on the classic VE curve model. This is an established model of governance. It gives decision-making power to those who are most long-term aligned in terms of their conviction in the network. It's really seen as a partnership rather than something that's passive. So what it aims to do is to reward participants for doing the work of governance, for that important work of making those decisions. The amount of power, in terms of decision-making power, is proportional to the amount of fill it's locked, is proportional to the remaining commitment duration. We propose that fill can be locked for a minimum of 1 week, so very low barrier to entry, up to a maximum of 5 years. All of these parameters are up for discussion. I don't want to focus too much on them at the minute. More canvas feedback on the main idea itself. Okay. So one technical choice in terms of veFIL is whether or not one should decide to weight power based on time remaining, simply like classic VE curve, or whether or not there should be a kind of non-linear function introduced here. So in the classic version, if you lock for 1 year, you get a 1x multiplier. If you lock for 5 years, you initially get a 5x multiplier. However, it's plausible, and this is something that requires more discussion. It's plausible that locking for 3 years is really substantially more valuable to the network and costly to the participant than locking for 1 year. So in this case, you might want to consider doing a quadratic function or some other non-linear function that more greatly weights duration. Okay, so who can participate? We propose that participation is open to all locked fill, meaning existing SP collateral can also participate. But an important thing is it shouldn't be entirely dominated by existing locked collateral. So we want to have other classes of capital come in and say, hey, I want to be a part of this. I want to earn some yield. I want to have some decision-making say. So this is why it's actually important to potentially have the non-linear weighting in terms of duration. So sure, if you want to lock for a week, that's fine. Or just the standard SP commitment of 1.5 years. That's also fine, but if you really want to lock for a longer time and be long-term aligned with the network, well then you should be disproportionately rewarded and empowered for doing so. Okay, so what will we govern with this proposed mechanism? So we're proposing that it's tightly scoped to governing allocation of a portion of the mining reserve to fund public goods. So the key decisions would be simple things like cadence, the amount of funding from the mining reserve to fund the public goods programs, the split between the different public goods, established public goods programs like Retro PGF and Pro PGF, and also as a means of having a pulse check on issues as they may arise. Stuff that's specifically out of scope, at least for now, would be things like core protocol upgrades, technical parameter changes, network security, and so forth. Okay, so a little bit more on the economics. We propose that there will be yield for participation, and we propose that as a starting point, 30 million fill is a reasonable point to discuss funding yield for this program. So we can I'll give you a little bit more detail. So we propose splitting the 30 million fill across a period of time, 5 years, where it ramps down from 10 to 8 to 4 to 6 to 2. And really, something to emphasize is that this must be seen as a bridge. It must be seen as a bridge to the protocol becoming self-sustaining. This is a general point across the protocol in all senses, but it applies specifically to mining yield also. Okay, yes, go ahead. Yes. There's more funding at the beginning. Yes. Yes. Yeah, so there has to be an acknowledgement that there has to be yield, and it comes from a finite source, and it has to be a transition from funding governance yield from this finite source to funding it with something more sustainable. And so having the amount decrease over time seems like the most logical way to do this. Yeah, go ahead, Warren. So it has to be replaced by some kind of protocol fees that are going to fund this. Yep. Yes. Yes. Yeah, so there's a slightly related point to that I'll come to in a second. Okay, so a little bit more context on the economic cost and the impact. So 30 million fill, it seems like a relatively large amount. Some people might argue it's too small, some it's too large. I think it has to be substantial enough to make a meaningful difference and not to be captured by a few groups. So if it's 30 million fill split over 5 years with the proposed ramp down, that would be 10 million fill in year 1. Ultimately, the goal is to dedicate the minimum amount of funding that elicits the maximum response to get strong governance commitments without excessive inflation. So that's the principle. In terms of a bit more context, so what is 10 million fill in year 1? Well, 10 million fill is 3.3% of the mining reserve, or approximately 5 months of block rewards at the current rate. If it's 10 million fill in year 1, and let's say the yield is 10%, then one might imagine that would correspond to locking 100 million fill. Now, the actual yield that is, this is an emergent, market-driven feature. So it's not necessarily going to be 10%, it depends on participation. The yield might be 20%, the yield might be 3%, but 10% is like a reasonable number. And if it is 10%, then you expect 100 million fill locked. So for context, 100 million fill locked, storage collateral at the moment is about 110 million fill. So that's just a little bit of context. Yes? Yes. Yes.
If a lot of people who choose to participate
Yep.
in year 1
Yep.
locked for 5 years.
Yes. Then they're also eligible. Then they're eligible for what is distributed in year 2 and year 3 and year 4 and year 5. But eventually, it has to transition to being self-funded, and that's just a fact.
I've locked for 5 years, so my fill is still locked, even though I got that 25x upfront benefit, and then the pool size is stepping down by a significant percentage.
I think there might be conditional unlock and stuff too. I think Tom might be getting to that. So like you may or may not get everything upfront, right? So we can design that.
Yeah, exactly. So that's a good point to discuss. But if you lock for 5 years, it's locked for 5 years. That's it.
So just going back to the previous slide again, so these rewards that we're paying out to people who lock up their tokens are, at least initially, directly coming from the mining reserve.
Yes.
And part of the goal of locking up tokens is usually to create a long-term deflationary effect. But in exchange for that deflationary effect of locking up tokens, we're taking a bunch of tokens out of the mining reserve and putting them back into circulating supply, which is having an inflationary effect overall. So is it long-term deflationary or inflationary as a system?
Short-term, it's highly deflationary because it's going to lock 10 times more than is immediately given out.
Short-term, yes,
Yes.
but long-term, is it going to have a net inflationary effect once those tokens get unlocked again?
Yeah, for sure. I mean, if you're giving out more, then that's an inflationary effect
Right.
Overall.
So from like a long-term value perspective,
Yes.
Right, if we pay it back, yep, that's my question.
So, yeah.
How is it deflationary if you're basically abstracting locked liquidity already? So that's liquidity that is already locked, that you're just abstracting with a different derivative.
No, so we shouldn't just target storage collateral that's already locked. Anybody can lock their fill and participate in this. And in fact, it should bias more towards new capital. Yeah. So I think that's a good summary, and this is why it's important to model and understand exactly how much you overweight longer-term durations, because most current storage SP collateral is locked for like a year. But if you substantially overweight 3 years, 5 years, then that's primarily going to be new collateral.
So just to clarify, sorry, over here. Hi. Just to clarify, the storage providers don't necessarily get a multiplier, right? Because they're not locking into the new locker. They already have locked it up. And they're getting like a 1:1 at max. But they're not getting a multiplier because they're not committing for 5 years or 3 years or 2 years.
I mean, that's to be decided. I mean, if the storage providers lock for 1.5 years, then I think it seems fair to give them the multiplier that corresponds to 1.5 years for governance locking.
You mean retrospectively, if they've locked in the past?
No, so it's purely prospective, forward-looking about future commitment. Yep. So, or about time remaining on the commitment. So the same as curve. Yeah, go ahead.
Sorry, I'm still confused. Are we talking about locked collateral, or we're talking about freely moving supply? Or ideally both, but first the collateral.
Ideally both. So if you exclude, I mean, there is a decision that could be made to exclude storage providers' locked collateral. But I don't think that would be the right thing to do, because this is a substantial group who deserve a say in governance.
Okay, and then in that case, the next question is, when you have that abstraction, the veFIL, how, I mean, like, what's the idea on the providers actually leveraging that afterwards, right? Like, you don't want to lock it out completely, so you still want the utility of the collateral, so you want providers to be able to use that as collateral. What's the idea behind that? Or is the idea to kind of virtually lock this outside of like any utility that the Filecoin network might provide?
So I think if it can be simultaneously used for backing storage as collateral, that's fine. Yeah. Vote, yeah. Or ZX, you want to comment?
But I also think that, like, even if, let's say, the yield is 5%, you lock up, what, 200 mil from, like, 10 mil field, you still have so much field out there that I don't think provider will be out of you to, like, participate, right? And I think, like, time is of the essence, too. Like, I've been advocating for a simple and a simpler model. If, like, I think Wook's question is, which I think is a good one, that, like, if people lock up a veFIL, already committed, can I use that for SP collateral too, right? That's what you're saying. But I feel like that pathway would be a lot more engineering work to do. So like, I think I'm okay with like, there's, even if you lock another 200 mil, there's still like, I don't know, close to 500 mil out there, so.
Yeah,
Question.
Vic.
Yeah. So if the question is like, using SP collateral locked fill isn't creating a net new locking effect, would you, I don't know, what do you think of having SP collateral be eligible for veFIL, but only if it's beyond the current lock period? So like, if I have collateral for like a year as SP collateral and I choose to lock for 4 for veFIL, then that counts as 3 for my multipliers. I don't know, like just find a way, because I get the point of wanting SP should be able to use what is locked and committed, but if you want to create a net new effect, then you can just adjust the multiplier for them based on what they've already committed to the protocol.
Yeah. I mean, I think that's a good point, and there's a trade-off between the magnitude of the net new effect versus this being something that's acceptable to everybody.
I think the numbers here are like a no-brainer. Like your final numbers here.
The final numbers?
Yeah, like you're saying you grab 10 million from the mining reserve, which is a small percentage, and that yields like a 100 million scale of locking at 10% APY. Yep. In reality, that balance is probably going to be even higher, like because the interest rates are going down in the world, so people like capital will seek higher interest rates. So the actual percentage might go down to like 8% or 7%, and that might still be profitable.
Yeah.
And so that and that leading to over 100 million FIL locked, which is at the scale of all of the storage collateral. That's like, to me, it seems like an obvious, like, massive win.
Yeah, I think 10% is probably.
Yeah, that's the point. It's like this would lock like another 100.
Yeah.
No, I think you would. I think you should probably keep it separate.
Yeah. So the proposal is not to keep it separate, as you said, although that is a design question that we can discuss here and see what people think. But the way that it's proposed to address that is through the non-linear weighting of duration, which would primarily attract new capital beyond the typical 1.5-year lock that we see.
I think the 10% is too aggressive because you're basically competing with folks like Glyph. So like, why would I take the smart contract risk, like also the risk of like allowing Glyph to lend that to providers and so on, if I have a native way of doing it for 10%.
No, so the percentage is market driven, right? And that's exactly the point. Like, I think like very likely it will be much lower than like 10%, I think. And also like plus you don't need to incur all the data center costs. You don't need to do all the data capture. You don't need to buy any hardware, and then you can unlock within a week. So like the real kind of like, the guess would be like the real APY here might be like less than 5%.
It could be, yeah. I mean, it's hard to know. I mean, on USDC, you can get 10% with centralized lenders. So that's like a rough ballpark, you know.
And a lot of other proof of stake network, their yield is like what, 3% or less? And then people still lock up like 30% of the supply just from like proof of stake. Even though we don't want to go into whether it's proof of stake or not in this setting, this is entirely just for governance. And also there's another decision point that we can discuss as a group, which is like, I mean, we want to be inclusive that involve the SP collateral too. Again, it's forward-looking, everybody's on the fair game. But if, as we said in Berlin, right, like if that creates more kind of like, oh, how should we design it if overcomplicating the problem, I think it's totally okay to just drop that requirement even. Because if this locks up a lot of fuel, that stock up liquidity, that will make all the SP operation like back in the game too. So like people will then onboard and then earn the yield from the SP side.
Yeah, can I just add? So actually, I spoke with Jonathan from Glyph about this concept last week, and his view is that it is something that they could build their business model on top of as like an underlying layer of new products that are financialized through this. Also wanted to mention, based on one of our case studies in the benchmarking exercise, Curve Finance uses this exact governance locker model, and that was the basis for it. And currently, 65% of the circulating supply of Curve is locked in one of these governance lockers. So it's been very effective. It varies. I don't know today, but it's based on like a pool model.
Yeah.
Vuk, yeah.
It's easy to ignore what's actually happening here, which is right now, like, so first as an ecosystem, like I do believe that we need to align on what we want to do, right? Like if storage is what we are trying to do, generally build a storage network and a great storage network. We've done a great job at designing incentives to push everything in that direction. And like, it's a hard thing to do, building a storage network that has like tens of exabytes of capacity is super difficult. And generally, like the incentives are really helping go in that direction. Like many things that happened in the past 3 years, like very advanced, like financing for providers, all these things would not have been possible if we did not find ourselves in a like economics that we had for the past 4 years. So now what we're doing is we're changing this. So like I'm not saying we are completely taking it away, but we're basically saying, Oh, the high pressure that exists today to deploy FIL into the protocol, and the only way of deploying this FIL is through basically providing the utility to the network. We want to kind of reduce that a bit and allow people to anyways deploy FIL, lock FIL, for probably a lower yielding a financial product.
Yeah.
But we are reducing the need for the ecosystem to find ways of locking more storage.
Yeah. So it sounds like you're kind of making an argument for not making the two things either or, so they can be additive.
Let's not ignore what's
Yeah.
actually happening.
Yes.
We directed the ecosystem for the past 4 years, mainly from this high pressure of finding ways of locking the liquidity inside the protocol, which is directly tied to the storage.
And also, like Juan is saying, if we keep them additive, like the SP can get even higher yield. That's why we want to be inclusive in this regard. But I'm also saying something else. I feel like even if it's not additive, I think it still be beneficial because, like today, if I'm bullish, I want to lock FIL. The first thing I need to do is I need to spend US dollars. Right, I need, everything has cost, right? Like, and I need to, even for Glyph and many other pools, at the current prices, it may not be rational for SP to borrow too.
Agreed. And one other idea here is instead of a pool of FIL, for example, you could do it a pool of only IFIL, PFIL, and related kind of derivative yielding types of FIL, which then makes sure that you first put the FIL to work in like a useful place, and then you only do the secondary yield on top of the other product.
Yep, that bakes it in.
Sorry, just by doing that, say you set aside 30 million up front, but you set it aside in IFIL that's also yielding, now your pool that you are distributing out to people is also accruing value through mining rewards over time. And so that pool itself will grow by, I guess, 3% per year over the course of the 5 years, such that you have more to distribute in your fund instead of just having it like sit there and do nothing. You can also do yield strategies on top of the pool.
Yeah, so I totally agree and understand and think that the easiest long-term way to pay some of these fees back is through storage provider lending. I think one of the dangers I've realized in the system, right, if we're talking about counting SP collateral as locked FIL for this, and we're talking about counting IFIL and Glyph stuff, the locked FIL that goes into Glyph is the same FIL that gets passed to the SP to use as collateral.
Like if you do IFIL or PFIL but not SP collateral, then that still works, right? Because
that's all I'm pointing out is that you have to keep those separate. You can't both include all of the like Glyph systems and SP collateral, otherwise we're double counting.
One way to do that. One way to do that is to look at the owner address, because if you pledge any of these pools, right, like your owner of the SP will be like the contract address.
Sure, yeah. If you want to get into SP collateral, there's a whole question of whether the owner address or the beneficiary address should be the one to earn the governance rights, which I think is a question of whether you want the lenders or the SP to really have the governance power in the system.
It should be whoever owned the field, right? It's like veFIL, so who owned the field, who has the governance right. If you're an SP, you borrow all your field from somebody else, you don't really have any claim over those field because you don't have as much skin in the game.
But they're also the largest, like they're the ones doing the work in the network. And in previous voting systems, we have wanted storage providers who have large storage enterprises to have governance rights associated with the scale of their enterprise, regardless of where the FIL that powers their enterprise is coming from.
Yeah, but
and so I'm saying it's a governance decision whether we want to assign those governance rights to the SP or to the lender. I totally understand people who work for large funds probably want it to be assigned to the lender. I imagine most large SPs probably want it to be assigned to the SP.
So I disagree. It's not because you work for the large funds or not. I think it's just from the first principle as a Filecoin stakeholder, like you are aligned with the network by holding the network's token. There are also many large SPs, they own large amounts of field too. Yeah, of course, like you have the right to governance and all of that with those field. Yeah.
a point here is that if you did, by locking it with an SP, lose, as a token holder, lose your governance control and your yield opportunity, you effectively not only are giving the SP the ability to use that fill for a period of time, but they also now get the 10% yield on that fill. Now you would either need to charge them an incredibly different price for loaning that fill from you because you know that they're getting this additional salary, or you're going to choose to not loan that to the SP so that you can participate in this directly. And now we have a competitive either-or environment, which was the point we were making before. So it either needs to be, the owner continues to have access whether or not it has been loaned out to a storage provider, or we just, put that all in its own separate pool, because otherwise I think we're going to add too much complexity.
Yeah, go ahead at the back.
I haven't heard the behavior that you want from these voters that participate in governance. And when I think about you want people who are going to be available enough to have high context, to make good decisions with like deep knowledge, the higher you put the APY, so you're competing with other financial things, you're basically subsidizing the cost that they're paying for their voting power, right? Because the opportunity cost of not getting that higher APY by putting in a financial market, using it for governance power, that's a cost that they're paying. It's an opportunity cost, but still a cost. And when you say like, oh, we'll do a nonlinear thing to do it, you're actually just discounting that cost for them by making a longer commitment. And so if you put your APY high, you're incentivizing people that want to set it there and forget it, not ones who want to govern and be actively involved in stake high context, right? So that incentive there is the one thing that I see that isn't addressed in it.
Interesting. Yeah, go ahead, Juan.
Oh, yeah, maybe just, I was just going to respond directly to that. I think the other important incentive behavior that we wanted to talk about is that the longer term you're committed to the system, the more voting power you have, right? So there's this incentive alignment between stakeholders that are in it for the long haul, that want the best outcome for the network, and the proportional amount of voting power that they have.
Just quick clarifying question. I somehow thought there was delegated staking involved, meaning you can put in capital and then delegate the governance voting to people that you think, or organizations that you think are doing a good job, and then you share some amount of your yield with them. But maybe I completely imagined that part of the...
This hasn't been explicitly addressed, but it's a feature that we should...
Proposal!
Yes. Good progress.
Yeah, hi. So this is like general, like I was just going to bring up delegation. So economic skin in the game is like important. So you still need to consider like the owner address who has economic skin in the game is allocated voting power based on how long they choose to lock up, even though they've lent or borrowed. And then second of all, if you choose to not have skin in the game and you want to delegate voting power, there's an entire secondary marketplace for delegation of voting power. But ideally, like best practice, your owner address, the one that has the economic skin in the game, should ideally be the one representing, especially treasury decisions as to how the economics are spent, right? Because it affects them at the end of the day the most. Second, I'm a little skeptical about this restaking element we're talking about, where your IFIL can be used for voting power here. You'd be at the risk of like double counting if you kind of undelegate your IFIL, but it's still over here, locked for 5 years. How is that accounting and rebalancing done at the same time? I think it just introduces those restaking complexities there.
Yeah, so I'm going to keep on going very quickly because I think we're over time by a good bit. But in terms of economic safeguards, so there is one significant economic safeguard that we could consider, which is to make the yield conditional. This effectively makes the proposal cost neutral. However, I don't think this is the correct approach, and I think it would majorly dampen participation. But that is an option, as one worth discussing. Another economic safeguard is that there is proposed to be a 12-month vesting period on the rewards that are earned. So everything's just a little bit more smoothed out. There will be an annual cap on the amount of the mining reserve that can be allocated to public goods governed through veFIL, for example, 5%, and as I said before, this is really part of a 5-year plan. It's a bridge. It has to be a bridge to transition to something sustainable, and it creates more of an opportunity to develop PMF more over the next 3 to 5 years. Okay, one quick point on philosophy. So there's another FIP, which is kind of a little bit similar because it touches on the mining reserve, which is to burn the mining reserve. So this is a little bit opposite in terms of philosophy. So the philosophy of veFIL is to do something with the mining reserve, to see it as a productive asset, and to really use it to grow fill utility and support PMF rather than just burning it. So it's kind of the opposite in philosophy. In terms of next steps, so we've been discussing for a little while now. I think there's been a lot of good feedback from this, but come and share more feedback. There's also a Google Doc. Everybody is extremely welcome to comment and make suggestions. I think pretty soon we'd like to open a FIP discussion and involve the community more widely. So there's a few open questions here, in addition to the ones that have arisen. So
we have two more questions, and then we'll take a quick break and move it on so that we can continue.
Okay, Vuk.
Are we sure that it's practically going to reduce inflation even in the short term? Because right now you have that fill sitting idle.
Yep.
It's definitely not hitting the market, maybe at times, but it's kind of in a balanced state. And basically you're saying that some of that idle fill, by locking it, we are reducing inflation. But is that actually the case?
So I think there's like a distinction between buying and selling and inflation and deflation, and the two things don't exactly map one to one.
Sure, but on that point, are we actually reducing inflation?
I mean, I think in terms of inflation and the flow of the token, as one would traditionally discuss inflation, yeah, I think so, because you're spending 10 million fill. If it's 10% APY, you're locking 100 million. But of course, it doesn't guarantee anything in terms of mapping to actual buying and selling. It's only a proxy.
Yeah, because there could also be a case where we are just locking fill that is anyways idle, and with that we are basically just increasing the inflation because we are emitting new fill.
If it's locking fill that's already idle and giving it something to do and participate in governance for 5 years, that's fine.
But this is focused on inflation or deflation. It's not focused on like utility or whatever else. So the main question is, we are introducing a new source of inflation, and we are saying we would lock a part of like some liquidity pool for a long period of time, and with that like also engage the community to like participate in governance. But are we actually reducing inflation even in the short term?
At least in the traditional sense of how I understand it, you're locking fill that's otherwise free to move. So, yes, that's right.
That's the edge case. Like if only SP collateral are participating, and then like you do introduce some inflation. But I think based on the benchmark, I think our take is, look, like the block rewards today is already very low, like 3%-ish inflation. We are throwing another 10 mil to it, so like another 2%-ish. So it's like not like a huge inflation. And plus with all we haven't decided on like the vesting, all the conditional and like whatever. So it's like we think it's like it's a drop in the bucket anyways.
One more question.
Yeah, sorry, Tom, over here.
Yeah, sorry.
Hey, Tom. So I guess, on the previous slide you had sort of like FIP 93 and then, this mechanism. There's another middle ground. I guess this is kind of a why now question. Like, what's the driver behind doing either of those things now versus just keeping the mining reserve on the side, saying the 300 million still for the future?
Yeah, for sure. Yeah. So the why now is We've prototyped these public goods funding programs. They've funded many great projects, great teams. It's becoming quite established, but it's not anywhere close to where it needs to be. It should be funded in a more on-chain, sustainable, decentralized way directly from the mining reserve. And if that's the case, well, then it needs to be governed also in an on-chain way.
Yeah, I guess there's a lot of debate and discussion about like whether that actually needs to happen now and like how true that is.
Yeah.
For me, a lot of what you presented comes down to the analytical modeling of it, and that includes things like sentiment and market reaction, right? To breaking the seal on the mining reserve, or however you want to say it, because there's inflation and then there's inflation expectations, and those are kind of two different things. Like one is an objective mathematical thing, and the other one is a philosophical or a psychological thing as much as anything else.
Yeah, totally. Yep.
I think to remove the kind of like inflation and deflation question entirely, it's just I would go for modeling a thing that has initial inflation and then you pay it back into the mining reserve, ideally with some interest. So you have like an actual very strong success case of this being a clear like way of supporting an important public good for the network that then actually makes money back for the entire network. And then let's figure out like the iFIL or PFIL type businesses of like how, if those are if they count as that, can you then get like some of the pool rewards to be bringing some amount of the fee structure that you need in order to replace we have to figure out like what are the set of fee structures that are going to come in after that initial bridge. And I think if we can get to like high numbers there, then I think this proposal works. But I think we have to figure out what those are.
Yep. Okay. Okay, excellent. Yeah, so sorry. Very quickly, no?
Well, I just wanted to say thank you for even putting this out there, because as someone in this ecosystem who's been trying to gauge and survey institutional capital's interest in Filecoin, it's so interesting to hear Vuk's comment as well as James's, because there are these two pieces. It's like, what is the actual goal of putting this fill into production? Like, what is the utility for our ecosystem, depending on your view and what your goals are? As opposed to the folks who simply have a very, very under-nuanced or very simplistic view of our ecosystem and could infuse capital, new interest, bringing new talent, yet more capital into the ecosystem. They don't give two shits, frankly, about what's the intrinsic value of putting locked fill or not locked fill. They just want to look at their very simplistic dashboards and see that our ecosystem has locked up yet more fill, because they're always comparing us against other ecosystems as a place to deploy their play capital. And so if our goals as an ecosystem is to increase the price of fill, it's a very different game. If your goal and your role in your team is to have more say in the ecosystem, you're going to play different games anyway. It just really goes down to like, what are we talking about here? What is the ultimate thing that aligns the majority of us? If the goal is just to lock fill, I think a lot of our points here, we could continue the debate. If the goal is to get new capital and to have our story fit the narrative that seems to be working for kind of the new political paradigm where folks are just comparing staking mechanisms across different L1s, this FIP is an entirely different discussion. Given that I'm selfishly representing the interests of capital markets players, I would like to say this is an incredible FIP that would bring new capital, and without this FIP, our ecosystem's not going to see institutional capital coming. And I say that with a lot of confidence.
Okay. Thank you.